Hello, everybody. We've got another Manifest Minute. I'm Adam Grantham, and we've got Andy obviously with us. And again, we've got David, who's here to help us go through some of the investment world that we've got going on. So, David, why don't you give us an update on the quarter and how life's going to affect us moving forward here?
Absolutely. Thanks, Adam. I appreciate
Yeah.
you having me. It's been very interesting past few months, looking at the headlines coming into, the end of the quarter. Obviously, everybody was very concerned about what's been going on in the Middle East. That was kind of dominating the market commentary and the headlines in the news. And it's amazing, kind of as soon as we had gotten, the ceasefire conversation, really it's been a shift from geopolitics and moving really into corporate earnings. And that's really where we find ourselves today. People have really been able to kind of look through some of the conflict that we've seen over there. And that's kind of not surprising in a sense that equity markets are really just kind of pricing what is baked into the future. And so now that we've kind of been looking past that, we've had a very successful earnings season in the month of April, if you can believe it. Technology stocks leading up into that period of time for the beginning of the year we're down about 7%. Now, since then, in the month of April alone, they were up about 20%. And so it's been a really strong earnings season. About half of companies that have reported so far, and about 80% of them have reported beats on their actual earnings. If you're looking at, some of the things like top line sales, those on average are up about 11%. Earnings in some areas of the market, like tech, are up almost 40% year over year. And as a kind of broader story, you're seeing, earnings on average are up about 23%. And so that's one of the things we look at for health of the overall equity market. And that's really one of the strongest predictors of future returns is earnings. And so it's been interesting to hear from some of the companies, learn about what's going on in the markets. Obviously, we don't have a resolution in the Middle East just yet, but it's been nice to kind of hear how they've been thinking about some of the complexities they've been facing, having the Strait of Hormuz being closed, having some kind of supply shocks, and then obviously dealing with things like higher energy prices, and then obviously some of the things that we're dealing with at home with higher interest rates and that sort of thing. So certainly no shortage of interesting headlines to talk about, but we've had a nice bounce off of the bottom earlier this year. If you look at the kind of peak to trough pullback in the market, it was about 9-10%, which
Mhm.
is kind of a standard pullback that you might expect. And I think it really gave people a good chance to kind of reset. So you're starting to see some optimism into the end of the year. And obviously, we're not out of the woods yet, but as the incremental headlines come in, we'll be continuing to monitor the situation.
Those are great thoughts. I just thought of one thing I'd forgot to ask you earlier, but we've obviously seen international equities perform much better probably over the last 12 to 18 months than they had for a very long time. So,
Yes.
do you have thoughts on why that is, or what has actually led to their performance maybe over the last 18 months?
One of the key things that's been out there, a lot of people have talked about the international trade over the last several years. It had been kind of stubborn almost as being,
Right.
mean reversion trade hadn't really kept up with the US. And part of that is because so much technology lives in the US benchmark, and that's been, a great trade. But
Hmm.
one key thing that's been going on has been the weaker dollar dynamic. And if you look at the beginning of 2025, the US dollar index was around 110. And
Hmm.
that has since weakened to just under 100. It's at 98, 99 today or something like that.
Sure.
Part of that's been due to weaker White House policy. So wanting to make it a more positive environment for reshoring and investing in manufacturing in the United States. So there's
Okay.
been kind of a structural push to have a weaker dollar. And if you think about how that affects international companies, a lot of the things that they're buying out there, factors of production like oil, like iron ore, things like that, tend to be priced in dollars. So they're
Sure.
effectively getting a discount by doing that. That helps boost their earnings, and their earnings are also denominated in their local currency. So having a stronger currency helps kind of act as a little bit of a tailwind. So that's been really positive. Emerging markets have actually been the strongest so far this year on average, if you're just looking at the different indices. And so that's been a key driver for returns in international equities, and something that if you speak to kind of our team and also some of the other strategists across the street, that weaker dollar policy probably will be in place at least through this administration. And, one of the things we were watching is with, the conflict in Iran, obviously the dollar is kind of a safe haven asset. And so during that time, it really only retraced about 3% back upward from that 98, 99 level. So it has remained weaker, and that again is supportive of international equities.
Great.
Good deal.
Anything else you want to add, Adam?
Yeah, another question for you, I guess. Maybe, different sides of the same coin would be if you could speak a little bit about inflation and energy, as well as the Fed dynamic and interest rates through the rest of the year, what we're expecting.
Sure, absolutely. Yeah, I mean, you think about the energy situation right now, obviously that the main shipping lane has been closed, and so that's been driving oil prices up. We've seen huge rises in that so far throughout the year. And, unless we get some sort of kind of major agreement for that to reopen again, there's going to basically be a supply shock that's out there. So higher prices for a sustained period of time. And that obviously affects, the broader consumer, that affects companies. And so energy prices are a key input into some inflation estimates and a key driver of inflation. So that's been one of the concerns this year is that if this conflict is really drawn out for a long period of time, that could make inflation more of a challenge. We were kind of coming into this year thinking, okay, 3 cuts, no problem. We're going to be able to kind of make our way and this inflation thing will go away. Not so fast. But this kind of puts the Fed in a difficult position in the sense that you have higher inflation that you're going to need higher interest rates to kind of fight if it lasts for a period of time, just higher, if the conflict basically lasts with higher energy prices. And then, you obviously at home have the consumer and, things like affordability for people buying houses, mortgage rates, all that kind of stuff, where
Right.
you've been seeing a lot of a need for cuts. So they're kind of in a tricky position. And now this year you've got Kevin Warsh coming in this month, actually, or this month. So he's going to be kind of the new leader at the Fed. We've heard a lot about his policies and just kind of what he's been thinking about for the overall market. And, I think that it would be surprising to get a bunch of interest rate cuts right out of the gate, given that backdrop I just talked about, despite what you might hear from the White House. So it's
Right.
definitely going to be interesting for this year and the remainder of 2026.
You do.
Awesome. Well, thank you so much for your time. We always appreciate your insights. It's great to be able to get your thoughts on a quarterly basis like this, and I think just keep people up to speed with what's going on out there. So, thank you so
Absolutely.
much.
Thanks so much, guys. I appreciate it.
Thanks.
Absolutely.
Yeah. Have a great day.